At best, a bunt. That's how Guy LeBas, chief fixed income strategist at Janney Montgomery Scott, describes Tuesday's action by Fed Chairman Ben Bernanke and the other members of the Federal Open Market Committee. Guy is one of the most accurate forecasters on the economy, and he joins us now from Philadelphia. Guy, welcome back to Bottom Line. Always a pleasure to have you on.
Thanks, Mark.
Guy, let's stay with that baseball analogy if we might. The Fed's announcement yesterday that it would likely keep its Fed funds rate at or near 0% through 2013. Was the decision a surprise bunt, a squeeze bunt, or a sacrifice?
Well, it doesn't seem to be a sacrifice, at least not judging by the market's response thus far. But, if you kind of take the range of options, QE3 is swinging for the fences. It's going long. Doing absolutely nothing, well, maybe that's a strikeout. So we get a little bit of action from the Fed. The market is responding in sort of a mixed fashion, reflecting both the downside economic risks, but also the fact the Fed is sort of standing by to provide a little bit of aid in what are increasingly challenged times.
Well, Guy, will that announcement yesterday be enough to calm the markets going forward?
Well, it doesn't seem so. If we take a look at the stock markets, just before the announcement, they were up about 1.75%. 15 minutes later, they were down 2%. So all we've really seen is more volatility from the stock markets. But getting away from stocks for a minute, if you take a look at the trend of bond yields, ever since the Fed announcement, they've been lower, 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 which is essentially what the Fed was trying to do. They talked interest rates down yesterday and, in effect, had some of the goal of QE3 in mind without actually executing those bond purchases.
Guy, Kit Jukes at Societe Generale summed things up this way. So far, panic has eased, but fears remain. Is that why we saw a literal reversal of fortune in the markets today? What happened to yesterday's relief rally, where the Dow surged ahead 6% in the final hour of trading?
Well, it's very hard to say what's going on a day-to-day basis in stocks right now. There are a lot of technical factors that are affecting the matter, and valuations remain relatively cheap, yet the outlook for profitability, the outlook for economic conditions, that's the kind of depressing part. And again, I want to make that contrast between these highly volatile stock markets and bond yields, which have been trending lower and lower and lower, implying to us reduced inflation risk and probably reduced growth for a long time here.
Speaking of reducing risks, is there now another chance of another U.S. recession?
There is a very substantial chance, and here's how I like to describe the situation. When economic growth is moving along really powerfully at 4 or 5%, it takes a really big speed bump to kind of get that car off track. Well, all of a sudden, when you're moving at a slower speed, a relatively small bump can have that effect of creating a recession. So we're clearly moving at a slower economic pace right now, and the sort of risk of that road bump coming up and really derailing that economic growth is significant.
Guy, the situation in the Eurozone is also weighing on global markets. Greece, Ireland, Portugal, they've all received bailout loans, and there is concern that Italy and Spain could be next. On Monday, the European Central Bank, the ECB, began buying billions of euros worth of Italian and Spanish bonds. Is there anything else the ECB can do to stop the bleeding?
Well, that's a good question. And to be honest, this is an issue of confidence. And it's much easier for a country or a company or whoever it may be to lose confidence than it is to regain it. So I think one thing the ECB can do is be very consistent day in and day out about their message, have the prime ministers and other officials in these countries be very consistent with one another. So we keep reinforcing that message over a period of not just hours and days in an emergency, but weeks and months over time. And that allows for kind of a slow repair, if you will, of these stresses.
Yeah, Guy, how exposed are U.S. banks to the European financial crisis?
Well, it depends on what country we're talking about. U.S. banks own relatively little Greek and related debt. They own relatively little Portuguese and related debt. But when you start looking about Spain, which has a substantial mortgage market, and especially Italy, which is the third largest sovereign debt issuer in the world, well, that's when the risks start to be problematic. Italy, in particular, is really what concerns us. But so far, that domino hasn't toppled.
Guy, in our last 30 seconds, are we going to continue to see these violent moves in the global markets, at least for the foreseeable future?
Yeah, I think volatility is going to be the norm. I would expect volatility to remain very, very elevated for the next several weeks until this attitude of the crisis du jour, if you will, starts to die down towards the end of the summer.
Guy LeBas, he is with Janney Montgomery Scott, chief fixed income strategist, joining us from Philadelphia. Guy, it's always a pleasure. Thanks so much.
Thank you, Mark.